Today's an exciting one. We're going to be going through my entire model. So I'm going to be giving it all away today. Obviously, if you've been in my server for a while, you know exactly how I trade. We don't gatekeep anything. But I'm going to formally introduce kind of some structure and some rules around how I trade. And we're going to be building on kind of the works of mentors of mine and also my own observations of price, right? And you're going to realize that most people trade very similar in this industry, and it's just about defining a certain system, right? So my system isn't per se unique. It's just about my own observations and things I've learned from my own mentors. Guys like AM and T Trades and MXM Trader, my first mentor. So we're going to be combining it all into my official trading model. Yeah. So for me, nothing is going to, as you guys know, when I teach, nothing is scripted, Jay. So when I teach, everything is going to be exactly from kind of what you're seeing from me on the charts. I have no pre-recorded examples or anything. So everything I do is going to be on real-time data. And for that reason, we'll be able to look at some examples which aren't the most picturesque or crystal clear. I believe that's an important part of trading, is looking at the examples that don't, fit the model in the most beautiful or ideal sense, because that's the reality of trading, right? The reality of trading is that things look a bit messy sometimes, as you've seen in the past couple of weeks. And every model gives you a lot of losses as well, which people rarely post about or talk about, right? I just blew your account. You just blew your account. It's okay, man. We've all blown accounts. I've blown hundreds of accounts before I was profitable. It's a part of the game. But I will tell you is that you will come back stronger if you stay in the game, right? People blow their accounts all the time. Once you figure out a good system, good edge, and you have a defined strategy, the money will come back to you. All the money you lost will come back to you and you'll make it back. But it just depends on the time frame that you're expecting it to, right? Don't rush the process of learning, and recognize that you're paying your tuition to the market, right? It's a part of the game. Yeah, you lose when you give up. Okay, I'm gonna start now, and if people kind of pile in, they pile in. We'll do it like that. So let me share my screen. And again, nothing is scripted today. So you guys have the chance. This is an opportunity for you guys, new and old, to ask me questions, right? To engage with me as I teach live. The reason why I'm not just posting like a YouTube pre-recorded video is because I think you lose a lot of the value of just having me here with you explaining things. So yeah, like ask me questions, right? Like ping me if something doesn't make sense. And yeah, let's work through it together, as opposed to just something that you watch and kind of, do it on your own. This is something that should be more interactive, okay? So let's get right into it. I'm going to start on a chart, an empty chart. Let's just do one chart for now. So today we're going to be talking about, I'm going to turn off everything, right? All indicators, everything. We're just going to talk on a blank chart. Pull up NASDAQ, it's our favorite. Okay. Today we're talking about a thesis trading model. And this trading model has a few foundational components. The first thing that I will always ask myself when I am trading is, what is my higher time frame draw on liquidity, okay? This could be something that you refer to as your daily bias. Now, the reason why my trading model emphasizes an understanding of the higher time frame draw on liquidity is because every other component of the model is only going to be viable and accurate insofar as I am trading towards the right higher time frame objective. I'm going to say that again, it's important. Everything is a pattern in trading, whether it's your entry model, your top-down analysis, or your confluences to get you involved in a trade. However, price will deliver to a specific draw on liquidity every single day, and aligning yourself with that daily draw on liquidity is the first step. Therefore, the question I have to ask myself before I talk about any technical confluences is, do I think the daily chart will trade higher or lower? Once I answer this question, that is the direction I frame my model around, okay? So the model I'm going to teach you today is going to appear every day on both sides of the market. You're going to get retracements that fit my model, and you're going to get expansions that fit my model. I am going to be teaching you how to trade alongside the higher time frame expansion. So the first step of the model is identifying what the daily bias is. Now the nice thing is I have a video on this. Exactly how I determine my daily bias. There's three confluences I use. The first is daily candle closures. The second is a concept we all know, or most of us know, which is internal range and external range liquidity. And the third is a concept known as order flow, which is essentially answering what PD arrays are being respected and disrespected. Okay? Where are we coming from? Where are we going? I'm not going to be teaching you guys daily bias today. I'm going to be framing most of the teaching today around the assumption that you're trading in the direction of the draw on liquidity. Because as you know, and as I know, when we fade that higher time frame trend, that's where more losses appear in the model. And that's where the signatures that we're looking for to enter price on are not going to hold up. Essentially, when we're offside, all of the mechanical steps we take are going to fail us because we're trading towards the wrong objective on the higher time frame. So that's the implicit assumption of any trading model, is that you can answer that question, where are we trading to effectively, right? That's a key caveat. Okay, so let's talk about what this trading model really looks like. So this is the key caveat, right? This is what really makes any trading model, whether it's my model or someone else's model, work, is understanding and positioning yourself on side with the expansion of the daily candle. Because every move against that daily expansion is going to be considered high resistance, and every move in the direction of that expansion is going to be considered lower resistance and higher probability. Okay, that's a caveat I want you to always consider when anyone teaches you a trading model, is that without a draw on liquidity, they're just patterns. We're just trading patterns, actually, unless you have a narrative, which is the word that ICT traders tend to use and probably overuse. So let's talk about what exactly the model is. The model is a continuation trend following system. So I want you guys to imagine a higher time frame bullish chart. A higher time frame bullish chart will present market structure that looks similar to this. This is the creation of higher highs, higher lows, higher highs, higher lows, and so on and so forth. As we know, if we can position ourselves at an area where a higher low is formed, an expansion, we are on side with the market direction and positioned to trade towards the new high that's being created. Now, this is very easy in theory, right? But as we know, the market rarely actually looks like this. This is a perfect example of maybe a higher time frame chart, but is rarely a good indication of the lower time frame chart. A lower time frame chart might look like this, right? If you zoom in to what is happening here, let's look at 2 points. From point A, which we'll label right here, to point B, whoops, which we'll label right here, which is the creation, again, of a higher high in a bullish market, right? That's all it is. This is what it actually looks like. This is the previous high, right, which we'll mark out with this line. We'll make it a green line just so we can label everything. That green line will be here, right? And then we're going to have point A and point B. Point A, point B. Right? So actually entering and aligning ourselves for this expansion leg is often a little bit messier than what we see on here. So we need a way to translate a simple trend following system, going from a swing low to a higher swing high, or if a bearish market presents itself, a swing high to a lower swing low, right? That fits the true reality of what the lower time frame presents itself to be like, right? Because again, if we enter in this region here, we're going to take a stop out, right? We want to position ourselves here. Essentially, the question we want to answer, and again, this could also look like this, guys, as you've seen. right? It doesn't, sometimes there'll be many, many manipulations, and any of these areas we enter could eventually stop us up. So the question we want to ask ourselves, especially recently, if you guys have noticed, the question we want to ask ourselves is, and this what the model really answers is, how and where do higher time frame swing points form? Right? When you think about it, you boil it down, how I'm trading is the formation of a higher time frame swing point. Remember, this is our, for example, let's say this is a hourly chart, and this is more a lower time frame perspective, like a 5-minute chart. We want to ask ourselves, how and where do these higher time frame swing points form? And then more importantly, what signatures can I utilize in price to align myself with the expansion or the creation of a new swing point, right? That's kind of wordy. Let's just say align myself with the expansion. What signatures in price can I utilize to align myself with the expansion? Because we're going to go from a lower point in the market that is created to a higher point. And this would be an hourly chart, and this would be a 5-minute chart. That is going to be the function of my trading model. It's identifying where reversals occur, how to recognize these lower time frame reversals, because remember, a lower time frame reversal is a higher time frame, what? Continuation. Remember, when we zoom in to this entire lower time frame perspective of the higher time frame chart, this lower time frame reversal right in this area here is simply a continuation of the trend that we're trading on the higher time frame. So when traders say that they want to trade with the higher time frame trend, what they're telling you is they want to align themselves with the higher time frame, you could say market structure or trend, right? And they want to enter on the lower time frame confirmation. That is the critical distinction, is that the lower time frame will give you some picture, or you could say a set of confluences that will tell you point A is now reversing, meaning we're forming a swing point here, and we're going to expand to a new high. On a higher time frame chart, if I was to show this as candles, you would see something like this. Again, bear with me. I'm going to be doing all of this live, so I don't have any schematics created for you guys in advance. I think it's better just to do it all live. Nothing scripted. That's the best way I teach, if you guys have noticed from my videos, is when I have nothing scripted. Right? If we look at what this chart looks like as candles and not as this line, it's something like this, where we get the creation of a swing point of the market. And again, if you look left here, you'd have lots more bullish candles, for example, if you're in bullish market structure, right? That support the trend, right? This is the bullish higher time frame trend that we are following. That's like that, right? Again, the first question is, where is the higher time frame draw? Are we going higher or lower? When we create this swing point in here, right, we have to ask ourselves, at this specific location, is price reversing here? How do we know that? What institutional signatures are present? If we can answer that, we can align ourselves in two specific locations. The first is what I like to call the reversal expansion candle, if it presents itself. So this here would be what the MXM trader denoted as candle 2. Right? So if you have 3 candles, generic candles, candle 1, candle 2, and candle 3. This candle in here can reverse and expand, and candle 3 is going to be the expansion candle. Or next candle. For those who have taken the MMXM Trader course, this is the next day model. And for those who have been involved in T and AM's work, this is known as the fractal next day model or the fractal model, right? This is all derived from that first MMXM Trader course that we all took. A lot of our mentors, a lot of us share the same first mentor. This candle 2 in particular is where I am going to be focusing today's analysis on. So many of you understand the idea of trading the next candle. What I'm going to show you today is here. When and how to trade this candle. If it is a reversal expansion candle. Now, why am I using those words? Okay, I'm using the words reversal expansion candle. Like that's kind of a mouthful, right? I'm going to remind you guys of one of the first things I've taught a lot of you guys who are in my server or my students, and that's about market cycles and also how price moves from different phases of price delivery. Okay, when the market has expanded, what can happen next? The market can only do a few things, right? One thing we know the market can't do is go from a consolidation, right? Say price does this, to a reversal. We do not go from expansion to consolidation to reversal. It's not possible. So if the market, remember, is going to reverse, I have a lecture on this, guys. It's called reversal signatures. You can go under the premium lessons and watch it. The market will either reverse and then expand, which is going to be expansion met by a reversal. So the market might be trading higher, right? Come in for a retracement, liquidate a low. So this is expansion. And then we have reversal. That would be the type of candle 2 that you want to position yourself in. Other times, this candle 2 will not expand, but it will simply consolidate. So if we have the low of this candle, right? Let's say this is that first candle low right in here. This second candle might just come in, sweep the low, and then consolidate above it. That is not likely to be an expansion candle. But the next candle will then, right, after this reversal into consolidation, what can reversal consolidation lead to? Expansion. So if this is confusing when I say a reversal expansion candle, just recognize that sometimes in the market, which is my distinct trading edge, a reversal candle will also expand because market will go like this, sweep the lows, and then expand all within the same higher time frame candle. And I want to look for what signatures in here are going to tip me off that this candle is going to reverse and expand. And I'm going to be teaching you that today. I'm also going to give you some rules as to where you look for this formation to even form in the first place. Okay? So that's the higher time frame idea behind my trading model. We want to position ourselves in the wick or in the body of a higher time frame expansion candle. That's it. We're going to be using time frame alignment, the 3 concepts we're going to use to build this model. So the thesis is we want to position ourselves within the higher time frame wick of an expanding candle. That's it. I hope you guys can see the simplicity of this model is that we want to position ourselves either in the wick of a higher time frame expanding candle or the body of an expanding candle. All right. And then we need to work backwards and say, okay, so what signatures in price, what model or confluences can achieve that thesis? Because if you guys can agree with the premise that I've outlined here, rather crudely, but it's still here, that if you're trading a higher time frame trend, there will be a moment where the lower time frame offers a reversal and the creation of a new swing point. If everyone can agree that that is how the market books higher highs and higher lows, look, if I have to prove this to you, we can do it on a chart. If we are expanding, let's look at a 4-hour chart even to be a little bit cleaner. The market is going to price in these points, points A, points B, right? Higher highs, higher lows, higher highs, right? Right? You can prove it to yourself that this, what you're observing in price, is exactly the same premise I've laid out for you here. Okay? Again, trace this as a line and you'll see. It's crudely the same thing I've shown you right here. Right? It looks a bit messier sometimes, and the market is a bit choppier and messy sometimes, right? Like we have a stop hunt here and then another one here. And sometimes we get multiple stop hunts of the same level or multiple wicks formed in the same level. But the idea, if you zoom out, is that there is a clearly defined trend. And that trend is the creation of swing points. So when I tell you I trade market maker models, what I'm really telling you is that I trade swing points. Or swing points are market maker models. Meaning, every time the market moves from point A, I'm going to get rid of this writing so you can clearly see here. From point A to point B, making a higher high or a lower low, there is a lower time frame defined market maker model that I am trading. And I am positioning myself in the market maker model at what phase? The reversal, or some of you might know it as the smart money reversal from the MMXM Trader course. Okay, so you see the way in which I've interpreted the MMXM Trader course from my other mentors, right, and also my own observations, is that if we have a standard market maker model, right, that looks like this. Okay, right, and some of you guys will recognize the schematic from your studies, or if you don't, that's okay. Say we have price retracing forming something that looks like this, which what we know to be is a market maker model. I have recognized in working with the MMXM Trader myself, and also just by trading, right, that these phases of accumulation and distribution are the creation of swing points. So if I was to take this perspective, right, let me move, oops. Let me copy and paste and put this all down here. This perspective, guys, looks a little bit like this. And this is the key distinction of my trading model, is the recognition that these market maker models, which I am trading, which I've always traded, come definitively from the creation. Sorry, as you guys can see, it might have been nicer to have these schematics ahead of time, but, you know, teaching live, right? Comes from the creation of these swing points, okay? So when we get reversals, I'm looking to qualify this phase of a market maker model with that swing point, which will eventually expand and give me a new higher point of data, okay? A new higher high. Does anyone have questions about this? Because if you guys can understand this logic, which I know is incorporating some concepts like market maker models and swing points, right? And market structure. But if you guys can understand the basic premise, then the model becomes very easy for me to teach you because the logic makes sense, right? You want to involve yourself where the lower time frame makes a reversal, right? And the higher time frame is simply continuing to create a new high. At the point at which the lower time frame offers you this pattern, which some of you might know from the MXM Trader course is a smart on a reversal. On the higher time frame, that's the formation of the wick. That's going to create a new swing point, just like in here. Okay? Just like there, just like there, just like there. We're creating the wick of the low that's going to reverse and give us a new high. Low, reverse, new high. Low, reverse, new high. The lower time frame is going to reverse. The higher time frame is going to continue. There it is. So now the next natural question must be, okay, Afiz, I buy that. I buy the logic here, right? We're trading the higher time frame, we're trading a continuation of the higher time frame, and we're utilizing this idea of a lower time frame, signature to get involved. What is that signature, right? So before I move on, does anyone have any questions about the logic of market maker models as swing points? Again, this is a bit more advanced, right? It requires some understanding, but ask me questions about that statement. A market maker model is a swing point creation. The question is this always in regards to internal range liquidity? We're going to get into that. In fact, the response I have is no. There's also things like continuation purges, right? But I'm going to teach you that. And you're going to have heard of some models like the Forever model by Matt or Sniper, which focuses strictly on internal range liquidity. Me and Matt trade extremely similar. We have the same mentor in MXM Trader. But I'm also going to show you how you can also use things like swing points themselves and stop hunts, right? If there's no questions about that, let's go into what this model actually looks like. So we understand the logic. We understand that market maker models are swing points. And let's talk about how we actually go from this higher time frame idea of where price wants to draw into to a lower time frame risk defined entry. Okay, so that's the next question. So I'm gonna get rid of all of this for now. So the next question now. How do we go from understanding higher time frame swing points, our MXMs, market maker models, to trading them, right? With defined risk. That's the question. So what we're going to do now is introduce a series of concepts or confluences, which we're going to use to bridge the higher time frame to the lower time frame. Remember, all we are doing in trading this type of model is going from a higher time frame swing point into a lower time frame chart and asking ourselves, if this is the reversal area, where do I enter on this chart? The lower time frame, right? This is the lower time frame perspective. That's the higher time frame perspective. Where can I define risk? What are the patterns or confluences of price that I need to see? How do I know that low is going to hold? That's the number one question is, how do we know we are forming a wick here, right? That's the same thing. How do we know the low will hold? These are the questions you need to ask yourselves. And that is where the mechanical steps of the model come in. These are going to be price signatures that tell us the low has formed. Okay, so what concepts are we going to use? We're going to use 3 concepts today. The first concept is going to be the idea of time frame alignments. Okay, the second is going to be IRL and ERL, which again, we'll go through each component. And ERL variance. So there's IRL, ERL variance, and ERL variance of my model. And I will teach you exactly what those look like. This one you've definitely heard of before. There's the Forever model, okay? And there's Justin Werlin also is calling his model the Forever model. This is what you've known as the Forever model, which is internal to external range liquidity. And it's looking at this exact same idea I just taught you with the key distinction of what being right here, guys. What needs to be here for the Forever model, which is a model that MXM Trader taught me as well many years ago. what needs to be there, right, in the forever model. What type of PD array? What's the requirement? Not SMT. Nope. It needs to be an imbalance. Yeah, yes, an FVG, right? The forever model variant of this entire idea of market maker models as swing points. So what are we going to call this model? I don't have a fancy name for it. I've been calling it to my students the Primo model. But this is a better description. It's just the MXMs as swing points model, right? No fancy marketing needed. Just the idea and the confluences of price, right? This variant in here requires an imbalance. This is going to be an internal range of liquidity, an imbalance, or an FVG, whatever you want to call it. I'm also going to show you a model that doesn't require a fair value gap, but can also use another type of PD array, a swing point itself. Okay, so we'll get into that, but it's the same confluence, and a lot of you guys have known about this model that exists in this form, right? It's something I trade all the time. It's something I teach all of my students to trade. Okay, so time frame alignments, the two variants, IRL to ERL and ERL to ERL, and SMT, or this is also known as smart money technique, also known as divergences, whatever you want to call it, right? There's a lot of names for things in the market. And the last one is going to be SysD, which is defined as a change in the state of delivery. So these are the four concepts we bridge, we utilize to go from the higher time frame to the lower time frame entry. This is how we build the model. We understand these four core components: time frame alignments, the variations of how price creates swing points. So when I say price is moving from internal to external, in your head, I want you to think of the statement price creating swing point. Okay, so whenever someone says market moves from internal to external, in your head, say the market is creating a swing point and trading away from it. Those are equivalent statements. The market is moving from external to internal. The market is creating a swing point and trading away from it. A higher time frame retracement is a lower time frame reversal. These are the core distinctions between just saying IRL to ERL and actually understanding what price is doing. It's creating a swing point. So use that language. And by using that language, you'll understand that every way in which you see many ICT traders trade is very similar. There's just slight differences, okay? We're all trading the creation of swing points. SMT. This is known as a divergence between correlated assets. You've probably seen it trading indices as NASDAQ and the ES. On things like gold, you can use silver. On things like crude oil, you can use ruble. There is lots of different types of divergences between assets. You care about the main one that corresponds to your asset. So for example, for today's lesson, we'll be talking about ES and NQ. Okay? And the last concept is going to be a change in the state of delivery. A change in the state of delivery is defined like this. And I always tell my students you have to write it out like this. The consecutive series of opposing candles into a key level with SMT. Boy, is that a mouthful, eh? What's the change in state of delivery? The consecutive series of opposing candles into a key level with SMT. Well, we know what SMT is. Now we have to answer what is a key level. A key level is going to be a higher time frame, internal range of liquidity, or ERL, which is a swing point. That is going to be your definition for a key level. So now, when you say, what's a change in state of delivery? Well, a change in state of delivery is the series of opposing candles maybe you can say this. On the lower time frame into a higher time frame key level with SMT. So what's the only part of this picture that we're missing right now? What's the only thing I haven't talked about that we need to properly define this statement then? Well, we know what SMT is. It's a divergence between ES and NASDAQ, right? That's where one index makes a lower swing point and the other index makes a higher swing point, right? So this would be your SMT divergence that looks like this. So we answered that. We know what SMT is. We now know what change in state of delivery is, and we now know what the model is doing. The model is the creation of these swing points, right? From lows to highs or highs to lows. We have everything defined to trade except one thing. What am I missing, guys? It's in the language right here. LTF and HTF. How are these things correlated? Yeah, we need to know which time frame are aligned, which time frames are aligned, because saying, well, a lower time frame and a higher time frame means nothing, right? There is a million different time frames on the chart. We need a source of truth. This source of truth is known as our standard time frame alignments, which I'm going to now teach you. Again, everything I'm covering, guys, in today's lectures, so I'm just going to make a note of this for the recording. Every concept I have discussed today, right, from market cycles, reversal signatures, market maker models, time frame alignments, change in state of delivery, SMT, the whole shebang, I have individual lectures on. I have individual lectures that go into great detail of all of these concepts, okay? And where can you find that? Go into premium lectures. Go into premium lectures. Spend time in there after this lecture dissecting the parts of the concepts that don't make sense, that you want clarity on, that you want more explanation on. I've spent hundreds of hours teaching my students and this community how I trade in individual parts. Now we're putting it together. But don't forget to go into these individual lectures. You know, I've spent thousands of hours, reading price and learning to trade myself. And these lectures are the summation of everything I've ever learned. I've not kept anything. So please go in there and take advantage of that. Okay, so these are the four concepts we're going to use. And the time frame alignments we're going to use are as simple as this. Weekly time frame, monthly time frame, daily, weekly time frame, 4 hour, daily time frame, 1 hour, 1 hour time frame, M5. Okay, and you could do one. There's one more that some people like to do, which is M15, M1, or M30, M1. I don't use those. I typically don't. So let's just stick with the higher time frame ones, because I advise my students to never use the 1 minute chart or anything really below a 5 or a 3 minute chart. Okay, so these are your time frames. Again, the way it's written out here is higher time frame cross with the lower time frame. Okay, you now have the recipes and the components necessary to build out a complete time frame aligned model. Right? I forgot one. You're right. Sorry. H4 time frame. Thanks, guys. Forgot one. All right, let's put this daily above that one. Okay, so monthly time frame is a daily chart. A weekly time frame is a 4 hour chart. A daily time frame is a 1 hour chart. A 4 hour time frame is a 15-minute chart, and a 1 hour chart is a 5-minute chart. Again, what does this mean? Again, what are we actually saying here? Remember, this means, and the words you should use in your head are monthly key level, daily, right? Lower time frame reversal signature, or swing point creation. Oh, now we're using the right language. Okay, let's do another example. Weekly key level. What is a key level? Internal or external range liquidity. What are those two things? Internal range liquidity is a fair value gap. External range liquidity is a swing point. There we go. Now everything is defined. IRL, ERL. No questions. That is a key level. Weekly key level means H4 lower time frame reversal signature or swing point creation. So if I was to say I want to trade a 1 hour, 5-minute time frame alignment for this model, I'm waiting for a 1 hour internal range of liquidity or swing point, and then I'm looking for a 5-minute reversal signature, which I have not taught you yet, but I will in the next, 20 minutes. That's how you should be wording it in your head. If I want to look at a 4-hour key level, fair value gap, or swing point, I am looking for a 15-minute reversal signature or the creation of a swing point. All of this is always aligned with the higher time frame draw. Remember the first thing I said to you. If you are choosing, right, a draw that is against the higher time frame. Say, for example, you're going from, let's just say, let's look here. You're trying to short from this 4-hour high, right? Back into maybe the low of the range. Or you could even say from this 4-hour high in here, okay? You're trying to short that 4-hour high. You're not going to ever be able to target the other side of the range here, because the higher time frame draw must be established for this model to work. Instead, you're going to be looking to long this imbalance, right? So this is a 4-hour key level. You're going to be looking on the 15-minute chart inside of there. Oh, look at this beautiful market maker model that forms. With that as your draw on liquidity, the original consolidation. Again, if the wording market maker model is confusing you, go watch my video. If this is confusing you, go watch MMXM top down. That's a 3-hour lecture on everything we're talking about here in detail, right? You're looking for that reversal signature to trade from, remember, that 4-hour swing low that's created. What do the higher time frame candles look like here? We have one 4-hour candle that looks like this with a low. Then we have another one that sweeps it. And then we have another candle that expands, right? Look, the creation of a swing point is a lower time frame market maker model, okay? This only works if you're trading with the direction of what? The higher time frame draw. That's the higher time frame DOL, which you guys saw me do for last week. That looks a little something like this, right? You saw me have my draws on liquidity all marked out in my analysis channel, if my screen loads. Give it a second, it's been slow recently. And maybe I'll even attach an image right now in the chat so that you guys can see it. This is what I mean by a higher time frame draw, okay? I'm going to go to my analysis channel and link it so everyone in here can see exactly how I do that. Because I'm not teaching you that today. That is going to be taught in all my other lectures that you can watch. Okay. There we go. Go click on that link if you want to know what a higher time frame draw is and how I define that. But essentially, like you saw, I had my draw on liquidity defined, right, as this original consolidation high. So all week I'm looking to trade long, meaning I'm not positioning myself in that short, in this short, in this short, in this short. What am I doing? Longing there, longing there, longing there, longing there. See that? Makes sense? I'm going with the higher time frame draw on liquidity because that is where the best expansions will occur in the direction of the higher time frame journal. Okay, cool. Let's keep moving on. So now we have our time frames. We have everything laid out here. And the reason why I've spent so long, guys, building out this groundwork for us is because this is what most trading models are lacking. They're lacking the logic, right? In fact, you'll just get told, I want you to look at a 4-hour fair value gap. I want you to wait for a 15-minute SMT and a change of state of delivery, and I want you to long. The problem is that it's significantly lacking an understanding of why you even care about that 4-hour key level, right? And this is what I want you guys to understand. Everything we talked about in the creation of swing points is the logic, the narrative for why price is reacting the way it is. Because if you believe that, then the trading model is simple. Then sticking with your higher time frame bias is simple. If you're just pattern trading it, I promise you, and I will make this a key emphasis, if you pattern trade this model, it will fail. It will give you more losses. It will give you counter trend setups that you don't want to take. You would rather align yourself with the draw than trade this model against the draw. And that's what a lot of people fail to see. And that's where a lot of pattern trading fails individuals as traders, because they don't understand why it's not working. It's like, oh, well, it printed exactly how you taught it to me, Afiz, but it just failed. And I said, well, did price want to go higher today and you're shorting the market? Or did it want to go lower and you're longing the market? Because you need to answer that question first. Okay. All right. I'm going to see if there are any questions. What if we are at the same time in daily and weekly key level? It's great. There's market maker models in market maker models. Yes. Swing points are created in swing points. Let me, you guys pull up that analysis chart. I want you guys to look at this. I'm just going to copy all the images in and we'll talk about it if I can pull it up on my screen, if it allows me to paste. It's too big. So I'm going to talk about these pictures right now. I'm going to post them all. As an aside, it won't be in the video because it's in Discord, but go to the chat right now, guys. Like the chat we're in, I'm going to post 4 pictures, okay? Okay, we're going to have a little discussion about that question. It's a really great question. Okay, so there's 4 pictures I just shared in the Discord premium stage, and they're just uploading. This is an idea, right, of what if we have conflicting time frames? What if there's a daily key level and a weekly key level, or a monthly key level and a weekly key level? These 4 pictures are going to answer that. As you can see, last week, I started on a monthly chart. What's the lower time frame to the monthly? The daily chart. So I had a monthly, daily market maker buy model. If you notice in the second picture, I also had a weekly key level, right? So I had a weekly 4-hour market maker buy model. I had a monthly model and a 4-hour model at play. Now watch how I analyze price this week and look at how price delivered with both models. The weekly external range liquidity, right, was the weekly 4-hour model. The daily and monthly draws were from that monthly key level. And if you look at that 4th picture, I have both plotted, don't I? You can see. I have daily external plotted, I have weekly external plotted, and I even have the monthly high. So those are all the different time frames that are aligning under a distributional model of liquidity, right? We're moving from a monthly low to a monthly high with SMT at the key level. We're moving from a weekly key level to the weekly high. ES took out daily highs, weekly highs, and not yet the monthly highs, but all those models, time frames were aligned. And you can see that in the distribution of price this week. So go into that analysis and look right here, right? Here's our monthly level. There's a daily market maker buy model. So this daily market maker buy model had the reversal signature right in here. Look at the monthly candle, okay? This is that. What type of candle is this based on what I just taught you guys? What's this called? This candle too is a reversal expansion. So the signature I'm going to teach you right now, that's called reversal expansion, is going to occur on the daily time frame from this monthly chart. You're going to see it when we go down to the daily chart. In fact, guys, this was going to be the example I did at the very end, so I don't want to give it all away. That's a really good question. Then look, we also had a weekly key level. See the weekly key level? This weekly external range low with SMT. So now we're going to have this weekly candle right in here, right, forming a what pattern? Reversal expansion weekly candle. Inside the monthly candle, that weekly candle is also going to give us that same signature on what time frame? The 4-hour chart. Right in here. Okay, the last thing we can say is, well, maybe we also had a daily key level, right? Which we did. Look, daily external range lows, daily SMT inside of a fair value gap. Perfect. I'm going to tell you that this day formed a what? Come on, at this point, I've already said it twice. What does this day form? We've gone from the monthly to the weekly. Now, what's happening on that day, which is within the weekly candle, within the monthly candle? Reversal expansion or reversal, but this is going to form that Primo model, which I've taught you, right? Which I'm now going to be teaching you today. That's what I'm calling it, which is just another way of saying, right? This is going to form a swing point. And what time frame is it going to form it on? The hourly chart. You're going to see that pattern form on this time frame, the 4-hour. Not a good time for my Wi-Fi to be so slow. I'm trying to make a point, an emphatic point. You're going to see it form on all the time frames. My trading view has been very slow recently, guys. Sorry. Anyways, let's get into it before this lecture lasts too many hours. So we have all the components we need now to build out this model, right? We have time frame alignments. We have internal and external range variance as our key levels. And we're looking for SMT and SysD within that key level. The best way to teach is to simply look at an example. So what I'm going to do is I'm going to combine all of this into a general schematic for you, and then we're just going to go to town and look at examples, because that's the proof, okay? Let's do the general schematic. So now, putting it together. Putting it all together, right? I always lead with theory, always, if you know me, and if you don't like that, then I'm not the educator for you. I'm never going to teach you a pattern. I hope you understand the theory, the logic. Let's put it together into something that looks more like a pattern, but it's not. It needs the narrative that we talked about. This is the Primo model, okay? And I want you to think of this as the swing point creation model. What we're looking for, I don't know why that just got rid of itself, weird. This is the general schematic. Okay. There we go, now it didn't get rid of itself. What we're waiting for is the higher time frame to look like this, the lower time frame to look like this. Using our time frame alignments inside of this point right here, where the higher time frame creates the swing. This is right here where the higher time frame creates the swing. We're going to define that as the reversal. If and only if we get the signature. So this is going to be our key level. Remember what a key level is? IRL or ERL, right? A swing point or a fair value gap. We're going to see if a reversal occurs in here. We're going to qualify the reversal in here with 3 things. The first, so let's actually map these to the same level so that you can see in the lower time frame. Okay, what are we going to need to see in here? One of my students, someone who's been in my server, someone I've taught, tell me what the confluences are in here. Write them in the chat. SMT, SysD. IFVG, nice, Tyler. I like that one. The IFVG is a new addition to my model. Very nice. Cool. We are going to wait for SMT with a correlated asset. What's a correlated asset? NASDAQ and ES. Okay. Remember, this is going to be, for example, if you're using hourly candles, this is going to be an hourly key level or a swing point that we're purging. And then on the lower time frame, so let's just define this for example. We're going to see an SMT with a correlated asset in that key level, followed by a change in the state of delivery, which is going to be the consecutive series of opposing candles into that key level with SMT. And ideally, there's going to be an inversion fair value gap in that leg or in this leg that qualifies that change in state of delivery. Now, I've done the work. That doesn't matter what time frame the SMT happens on. You want to look for the SMT to happen on the associated lower time frame. So inside of that gap, you want to see, like, if there's an hourly fair value gap here, right? Inside that fair value gap, there will be a swing point that's on this side of the market that looks like this, right? And you want to see one of the indices take out that swing point and the other one make a higher low, okay? Something like that. And we'll go through example. You want to see the IFEG ideally in the leg that creates the manipulation. Now, I've made the liberty of creating a PDF for you that exactly covers this. So I'm going to send this to you guys in the chat right now because it looks way better than this. So let me show you. Where is my PDF? Give me 1 second, guys. I'm finding it in my lectures. Just give me 1 second. Here we go. I just made this for you guys in advance so that you guys can have this. There we go. So now you guys will see this picture. I've defined it for you here, okay? This is what you're looking for. Inside of that key level, you're looking for this to form, okay? Notice how it's all pretty and it makes a lot of sense here. So please, take this PDF, screenshot it, add it to your trading journals, add it to your desk. A lot of my students have it printed out and they use it every day. This is what I've made for you so you can actually understand this concept in a little bit, clearer words, and also with the nice time frames all aligned for you in a beautiful schematic, right? So that's what we're looking for inside of this key level. Now, this is going to be the trading of candle 2. So remember, this is the reversal candle. So I'm going to draw out 3 candles for you, and I'm going to overlay them. The first part of this model is trading the reversal candle, which looks like this. This is the model that I have made all of my payouts, for the most part, trading. So all the payouts you see me take have been predominantly entering inside of this candle. You guys all know T-Trades, the guy I'm living with? T-Trades has something called the fractal model. And can someone in the chat tell me what candle T-Trades' fractal model looks to trade? The candle I trade or a different candle? Third. Yeah, C3. So does everyone understand which candle? If I ask you guys now, right, which candle is this model pertaining to? C2. This is a reversal signature model. I like involving myself in the candle too, because what can candle do? What's it called when it gives you a certain type of movement? It's called a reversal what candle? Someone tell me in the chat. Reversal expansion. I recognize that oftentimes candle 2 not only reverses, but it also expands against the manipulation leg. Remember, there's 2 phases of a candle. The two phases of a candle look like this. This is something you guys have learned from my protraction profiling. This phase in here is known as protraction, okay? So this in here is market manipulation phase of the candle, where the candle forms the opposing run. Sometimes you'll hear this as opposing run, okay? That's what I define as protraction or manipulation. Then there's this phase of the candle, which is the expansion phase. I don't know why everything's in capitals. Sorry, guys. So the expansion phase. Oftentimes, a reversing candle will form an opposing run and simultaneously an expansion phase of price. So I want to be involved in the expansion of price if it's offered. The number one confluence, so the people who stay around and actually watch live, you're getting it all. The number one confluence to determine if there's going to be an expansion phase of that candle too is what? Someone tell me what they think it is. How do I know this candle is going to form this? So this, let's say these are two types of candle twos. This is reversal expansion. The other one could look something like this. Reversal consolidation. Remember market cycles. Okay, if these words are unclear to you, go watch a fees lecture. IPTA market cycle. Okay, this will clear up a lot for you. A lot of the language I'm using is based directly from that lecture. Okay, so this is going to be the reversal expansion. This reversal consolidation candle is not going to look like this. Instead, it's going to look more like this. Do you think we want to trade a candle if it looks like that, guys? Yes or no? Nah, right? It doesn't interest us as much, right? It's high resistance liquidity. Now, the reason why it's high resistance can be defined for a few reasons. So what signatures tip me off to if we will get a reversal expansion C2? How do I know we're going to get a reversal expansion? What are some confluences? You guys are experts. I want you guys to put this in the chat. What's one confluence? Displacement. Yeah, I like display. Time of day. Yes. Okay. I'm going to give you a couple things that are more objectively measured. Okay. C2 runs against a previous higher time frame consolidation. This is such a guy. I'm giving you guys all the things I've never put all of this on the internet. So this lecture is gonna have everything I look for. Please study this one. It's all here. C2 runs against a previous higher time frame consolidation. I bet you've never heard of that before. Think about why I'm saying that. What is so important about a higher time frame consolidation being ran? What have you ever heard about small ranges and large ranges? This is from Larry Williams. It's a direct quote. What types of ranges result in large ranges? Small ranges, right? Small ranges lead to large ranges. So when you have price, think of price, guys, like a string, okay? The string only has so much length. This is string. When price is oscillating up and down, what do we call this phase of price, guys? From a market cycle perspective, what's this called? Accumulation. Okay, so this is your accumulation. I'm going to give you guys a succinct justification for why people say AMD and why it actually works. This is going to be based in logic again, not a pattern. Again, theory first is what I'll lead with. Accumulation. We get a deviation of the range low in candle 2, right? So this is going to be our deviation of the range. Some people will call that manipulation, okay? The question I have for you is how much string, right, have we used in this amount of time? So as price makes its run, how much string have we utilized before what we're going to call distribution? Do we use a lot of string or a little string here? Again, let's follow the string. At this point, how much string have we used? Not much, right? Think about the string being stretched. Here, it's not being stretched very much at all, right? It's going up and down. So it's very relaxed. It's just like waves, right? Then eventually you get a sharp move, which uses some string. Again, pay attention to that language. This move in here utilizes some string. We're going to come back to that, okay? That statement. And then we have the rest of the string to expand, right? So we can use, we can use more energy in that expansion if the previous part of the price action was an accumulation. So let's blend the analogy. If price is moving from a higher time frame, small range, which we define as consolidation, then price can expand into a large range after forming a candle to low. Put it all together. Let's use those words. If price is in a higher time frame consolidation, not using much string, candle 2, right, can form a low and expand once it runs against the previous consolidation. That's one way I can actually look for a candle 2 to reverse and expand, is if we have an accumulated range beforehand and we're order pairing the lows and the highs. Yeah. So you also heard the other one in the back, which is from T-Trades. So let's use that string analogy, right? When we make that opposing run of candle 2, what did I say this part uses right in here? There's 2 points we care about. We're going to zoom in. So this is point 1. So confluence 1 is right here. Small range or accumulation. Okay. That's confluence 1. Let's make this a different color. Confluence 2 is right in here. And it has something to do with this opposing run. Why is this not updating? It has something to do with this opposing run right in here. Remember what this looks like. This is candle 2, okay? I'm not good at making schematics, guys. I was never good at art, but this is candle 2 in an expansion, okay? What about this area of price can give you an indication that it's going to expand? The wick, yes. So a small or large wick, which one do you think uses more string? Let's keep the string analogy, or just use more energy, right? Uses more of price, a large one. Okay. So if we have a large wick, do you think that price is likely to reverse and expand against it? Probably not. The second confluence, you've answered it using your own good logic. Small. Let's actually use let's use better language. Smaller opposing run. Remember, the run is against the consolidation, right? That's the first confluence. It doesn't have to be a consolidation in all cases. Sometimes you'll see it won't be, but these are two confluences. So these can exist independently, but the best is when they exist together, right? A small range before accumulation, sharp deviation of the range with a small opposing run leads to that beautiful distribution. That's when you get that A plus C2 distribution, is when you have these confluences stacked. Okay. There's also one more confluence that I've noticed. So C2 forms a small opposing run. Wait. There's one more confluence. Think about the idea of order pairing, okay? What happens if price, instead of doing this, looks more like this? I'm going to draw you another schematic. What's the difference between these two? The range high has already been purged, right? This is a double purge. And according to MXM Trader, sometimes double purges result in the most explosive moves because it takes out both sides of the market. So another thing I'll look for is a potential C2 double purge. So do you see how we're building criteria around candle 2 to say if it's going to be high or low probability reversal expansion or just reversal, maybe into a consolidation after? A double purge might give us an indication that a large move is coming, and that was based on some information I learned from the most recent MXM Trader course, right? Always updating and building my model around, other great educators. So this is something that's recently introduced. Now look for that before candle 2 forms its low to see if we potentially run the high with a shallow raid. What's range high? Use candlesticks here. Which range am I looking at? C1 high, right? Small opposing run of C1 low. There we go. Do you see how that can also lead to an explosive move? That's where we're also going to look for candle 2 to reverse and expand. So I've given away something I haven't talked about much before online. This is what I look for in C2 reversal expansions: a double purge, a small opposing run, and an accumulated range to the left of what I'm trading to be a reversal. Add these confluences and watch how you actually see candle 2's printing those large expansions. Okay, so that's where I look for candle 2 to reverse and expand, and I try and avoid candle 2 if it's more likely to be a reversal and consolidation, meaning I don't see one or all of these signatures in candle 2's manipulation. So if I see a candle 2 that doesn't have an accumulated range to the left, immediately I'm thinking it might not expand, potentially. If it forms a deep opposing run, I'm thinking it might not expand. And the double purge for me is more like an even better if. An even better if is like if we wick shallowly the range high and then we form double purge. Now I've learned that, right? Is there a range of points that classifies a small wick? I would actually look at the wick in the formation of price and time. If we open up our candle and immediately take out the lows and then start to push back into the range aggressively, there's a lot of time left for that candle to expand, isn't there? Remember, this is a candle built in time and price. If price spends the majority of the candle creating the opposing run, how much time is left for it to expand? If we get our change in state of delivery here in candle 2 with 10 minutes left in the candle, right? This candle probably isn't going to expand, is it? But if we get that change in state of delivery 10 minutes into the candle with a very, do you understand how time is actually going to qualify the opposing run? Think about what you just asked. It's not just about price. It's also about time, right? Because if price manipulates deep below the previous candle's low, if it does it very quickly, I'll still consider that to be, in many cases, a shallow manipulation, because the string, although it uses a lot to go lower, you guys have seen this on like news, like a huge wick against and then a fat wick down, an immediate reversal. If we form that opposing run quickly in time, I know that candle has a lot of price left to still distribute over time. But if we only get that change in state of delivery halfway or 10 minutes left in the candle, what candle do you think I'm going to trade? Candle 2 or candle 3? Candle 3, right? Because it's not just about price moves, it's also about how quickly price is moving. So if we form, this is the last confluence, if C2 sys Ds early, right, in the candle, there we go. Does that make sense? That one is a bit more complex and nuanced. But I want you to remember that each candle is a function of time and price. So if we get a small opposing run, it is very likely that we will close back above the consecutive series of candles, changing the delivery state, with lots of time left in that candle. That time is going to allow us to expand for the rest of the candle. If we only get this change in state of delivery with 5 minutes left in the candle, it is very likely that that candle will not expand aggressively in just 5 minutes on the hourly, for example. So I will wait for the third candle to open, form a low, and then trade, right, with time and price for an expansion. Remember, you are trading what time frame chart? You're trading the higher time frame chart. Your entry is aligning the lower and the higher time frames. Your entry is the lower time frame, but you're trading this hourly candle expansion. Remember, the model is the creation of a swing point. What time frame is the swing point being created on? The higher time frame. So you're aligning a lower time frame entry with a higher time frame expansion. Again, there's a lot of stuff in here, guys, that's getting a bit more complex. I understand that. And to that, I will say that trading at a high level of, mastery is complex. It's not easy, but you don't need to understand the most complex versions of what I'm saying. What I want you to understand is that there's a logic to everything I'm teaching you that is based in more than just a pattern here, right? So, number 4, I guess the way you can look at this is that if candle 2 forms a small opposing run and it shifts delivery state early, let's say in the first half of the candle, I know that there is another 30 minutes or half of an hourly candle for us to expand. So I will also use a time-based filter for the change in state of delivery. So when people say you trade time and price, that is what I actually mean time, right? The earlier in the candle we form a change in state of delivery tells me 2 things. First, we probably have a smaller opposing run, unless it's like an FOMC wick. And you guys have seen massive wicks higher and massive drops lower, like a huge wick forms. The second part of that is the key element of time, because if there's lots of time left in that hourly candle, if the higher time frame is your hourly chart, that means we have a full hour to trade what? If price is reversing, what's it likely to do? Expand, right? That's the entire model, right? Is the creation of a swing point and trading the expansion. So filter it based on price, and then if you want to be even more particular, filter it based on time. And that's a hidden gem I've never talked about. I've never gone on live. I've never taught my students even until now, because I've been putting the confluences together. The time-based filter for candle 2 is important, because if it is not displacing in a certain amount of time, I will say it's more likely to do what in that candle? Say we get a chain of state delivery and we don't start displacing chop and consolidate. That would be a reversal consolidation candle, which I've now taught you looks like that. So you're going to look for these 4 signatures. Runs against a previous higher time frame consolidation. Remember, that's when the hourly candles are going to look like this. Okay? We're running against that. Pretend this is a small wick relatively. Then we have a small opposing run. Then we have a early sys-D, right? An inversion fair value gap, because inversion fair value gap is telling you what? Why do I use inversion fair value gap, guys? Remember, I'm going to point you back to this schematic, which I want you guys to all save. Why do you think I use inversion fair value gap? What's that telling you about the market? Yeah, it's telling you that bullish or bearish PD arrays that were previously holding price are being disrespected. That by definition is a change in the state of delivery, and it shows momentum and speed. You want to trade with speed in the market, and the inversion is giving you an indication of that speed. That's why I use inversion. So C2, sys-Ds in the first half of the candle is ideal. And then it forms a small opposing wick, and the double purge is the new addition, right? These two are the ones you probably have never heard of, right? You probably have heard of these ones. Higher time for consolidation, that's AMD, right? You guys have all heard of AMD. But what you haven't heard is double purge and time. Those are the 2 things that I added to make my model unique, right? Yep. So now that you understand the model, right, in all the theory, let's get into how we trade it. And again, to trade candle 3, you guys know we're going to wait for an opposing run and then a change day delivery with SMT. So the last thing I'll talk about is candle 3. How do I trade that? That is strictly a continuation candle. Now, I learned this how to trade candle 3 from T-Trades. T-Trades taught me how to trade candle 3 because I traded candle 2 exclusively before, and now I know how to trade candle 2 and candle 3. And his model is candle 3. So what I'll do is I'll briefly explain it, but he is the one who's kind of mastered trading that third candle. So obviously, go look at his most recent YouTube video. Go look at his video on that explains the indicator. That is like the template for trading the next candle or the next day model after our reversal candle. I've made my payouts and my model around candle 2. T-Trades has exclusively looked at that candle 3 and getting involved in that. But I'll teach you quickly, right, because we trade very similar, how that candle 3 works. So say, for example, we get our change in state of delivery in candle 2. So say this right here is candle 2, gives us a change in state of delivery. And this is the open of candle 3. All right, what I will do is wait right here. This is candle 2, right in here. So you can say all of this in here. I don't know why it won't drag. It's weird. Strange. One sec. I'll just draw another schematic over for you guys there. So this is all candle 2, right? Which takes the low of the previous candle. That's our liquidity sweep, right? Remember, we talk about it right here. So that's the purge of candle 1's low. What else do I need to see in here, guys? Now I've taught you the model. What are we looking for in here? Tell me the things that we're looking for. SMT. What do we need to be in here? What do we need to be? What am I missing? Right here. What should this be? Everyone put it in the chat. Come on, this is the foundation for the model. What do we need to be in? Key level, key level. Good words. Yes, Pierre. Key level. Good job, Andressa. Key level. Yes. Do you trade this model, question, without a key level? Hmm? Do you ever trade a wick of candle one's low that just looks like this without a key level? Yes or no? No. That's pattern trading a wick of a previous candle low. I don't do that. You need to be trading into a higher time frame imbalance or a swing point. Okay? So it's not just one candle low being swept. And T does a really good job of explaining how you use time frame analysis to find those higher time frame levels. There needs to be a key level and a defined draw on liquidity. If not, you're just pattern trading it, okay? And it won't work because you're not going to have an expansion, right, formula in the market if there's no higher time frame manipulation. Remember, the market needs to draw into that key level for us to offer a lower time frame reversal, or else there's not enough juice, right? There's not enough gas in the tank to even allow for expansion. There needs to be order pairing of a higher level. And if that sounds confusing, go watch my video on order pairing, and that will make more sense. We need a higher time frame key level. This is C3's open. So how are we going to trade C3? We're going to wait for an opposing run to form. Plus SMT. How do I say, for my students who have been learning from me for a long time, what is the only way a swing point forms in the market? What is the only way a swing point forms? SMT. SMT is the only way a swing point will form. So when we get the new candle opening, we wait for the opposing run, which is defined as our manipulation or our order block, right? Then we wait for a change in state of delivery. Oh, look how similar this is to candle 2, guys. The opposing run, the change in state of delivery right here. Okay, so right here, that's your opposing run. And we need to see for that to be considered a swing low, just like down here, an SMT. Giving away all the sauce, guys. Not gatekeeping anything from you guys. There it is. Enter in candle 3 once we get a intra candle 3 changes day of delivery. The same criteria that qualifies a swing point being created on the hourly will qualify a swing point being created on the continuation candle. What do I not need on the next candle? By definition, because it's a continuation, not a reversal. Remember the lot, guys, do you see? I'm getting excited and teaching you because if you've watched my content, you know there's a logic to this. What does every single reversal need? Again, the reason why I spend a lot of time teaching you guys theory is because you should really see that the way in which we perceive the market is not based on a pattern. What does a reversal need? And we're using words specifically. We're not just saying things. What does a reversal always need? What does a continuation need? So that's a reversal. I'm really giving away everything. This is everything I've spent 3 years learning in the market, guys, all in one video. There we go. Okay, you guys can never complain about me not putting out my entire model ever again. I did not think I'd be going through everything like this, but I'm very glad we're doing it. There you go. You guys see the logic there? When we are reversing, we need a higher time frame PD array. That's why we have the key level, and C2 must trade into that key level. When we are continuing, we do not require the higher time frame PD array. We just need the swing point to be created. How are swing points created? What two functions? SMT, change in state of delivery. A reversal swing point, remember, a reversal swing point. So what this is saying is like reversal swing point requires three things. Needs a continuation swing point, needs so go watch my market maker model top-down video, and you'll see exactly how these pertain to what. Again, me talking about these levels or what state. Do you guys also recognize how this is just a blending of market maker models? What would this be called, guys? Down here in a market maker model. Someone tell me. Someone who's really, really like studied my stuff. What is this called down here? SMR? Yes. Okay. Then what is this called? Low risk entry or first stage of distribution, right? Sometimes inside of the SMR, remember when we get that change in state of delivery, we'll get that low risk buy as well, right? Sometimes in candle 2, we'll get offered the entry. Other times we'll wait for candle 3. This is how we know. So another way I could say this is we trade candle 2 when it offers what? The low risk entry. You see? There you go. We trade C2 when it offers a LRE, low risk entry. When it doesn't, that low risk entry will be offered when? Candle 3. That is how you can define an area of the market maker model you're participating in, right? So then people ask, then why do I limit order as we change delivery, or why do I market order as we change delivery state? Because sometimes, as you'll see, price does this, right? Once it shifts delivery state here, it doesn't offer the low risk entry till where? Much higher in the range. That's why you'll often see me limit entering inside of that change in state of delivery, or market entering. As soon as we change delivery state, you'll see me enter on candle 2 because I'm thinking candle 2 is going to do what? Expand. So then candle 3 might consolidate, manipulate, and then further expand. How many times have you guys seen candle 3 consolidate? Right? Go on your charts. Don't believe me, just look. I will prove it to you. Look, this candle, let's look right here. This candle is a candle 2. What does candle 3 do? Does this candle expand? Or does it consolidate? It consolidates. What candle do you want to be involved in? You can't trade just candle 3 here, which is why I'm teaching you a model to catch a candle 2 reversal. Do you see the power? This is where me and T-Trades have slightly different trading styles because he doesn't involve himself in candle 2, and I will almost exclusively try and look for these candle 2 expansions because I want to get involved before candle 3 does this and just chops because, again, market cycles. Does market ever go from consolidation to manipulation to expansion to expansion? Does market ever go from expansion to expansion? Ever? Is that allowed? Can we go from expansion to expansion? No, we go from expansion to consolidation, expansion to retracement, expansion to reversal. It's not efficient. That's the best way to say it. Market needs to pick up more slack in its string. Remember, we're using the string to displace. We need to build more looseness of the string, and then displace again, build the, right here, the string is stretched, so it needs to recoil itself. In doing this, it's like a coil. All of this expanded coil is now being dragged up, and then we're just getting smooth again. We'll get a retracement, then we'll get another expansion, okay? Market does not ever move like this, and market does not ever move like this. It moves like this, right? It moves in functions of consolidation, expansion, consolidation, expansion, consolidation, expansion. So when we are looking at a candle 2 to expand, candle 3 looks like shit sometimes. Have you guys seen that this week? Like, who here traded a candle 3 that just chopped all candle 3 this week? Like hands up, right? Like put your, I know I did, because I didn't recognize that all of the juice was used in candle 2, right? So that's why my model is especially primed for catching those second candle expansions. Okay, so go back here, right? A continuation needs an SMT plus SD. That's where we're going to get involved in candle 3. I'm giving you guys everything I use to trade here. Okay, anyone have questions about the model? This is it. This is the sauce. If you guys want it all on one page, let me put up this these two images. So this is another image that you might have seen me put in before. Again, this is mapping the candles to a market maker model. You'll see it right here. And then there's this. The reason why I've made all my PDFs so consistent with all of what I'm teaching you is because I'm trading the same things. Here you go. This is it. That's the entire model. This is how we relate our entry function to our market maker model. And here's how we relate market maker models to swing points, like that. We relate market maker models that look like this to these swing points that you see right here. That's how we relate them. That's what this looks like. Then we use a chain of state delivery entry function along with these confluences to get involved. And then the logic and the execution is mapped, and that's it. And then we can make money in the market with a consistent model, right? Okay, so let's do some examples, all right? Again, this will all be recorded. You'll be able to see all this. Let's do some examples. We only need to do a few. Let's do someone give me a higher time frame. Just throw it in the chart. What do you guys want to do? How do I incorporate protraction profiles? You'll have to go watch those videos. I use that for my daily bias. So again, all of this model relies on one assumption. You have a good idea of the daily bias. Are we going higher or are we going lower? Trade this model in that direction, not opposed to it. How do I build daily bias? That's my next big lecture I'm going to do. I use protraction profiles. I use IRL, ERL, higher time frame, and I use candle closures on higher time frame charts. That's my 3 concepts. But today we're not doing a daily bias video. Today we're doing a model entry video. You guys already know how I build daily bias, especially my students and people who are in my Discord. You see me build a daily bias every day using these things, right? Or else the model has no weight. The model is useless unless we know which direction we want to trade it in, right? I use weekly profiling and daily profiling for my daily bias. Yep. Why MXM is focusing on C4? Because again, once you have a reversal printed in the market, the next day model is once the swing point forms. And if the draw has not been met, this is going to be what stage of a market maker model? You're asking a really good question. Again, I want you to remember this is the draw. This is a really good question, and it's a perfect time question because what stage of a market maker model is that? Again, the reason why MXM Trader taught me pretty much, most of my foundations, because all the information I'm teaching you guys comes from learning from him at first, right? And now I'm just putting it together with some other stuff of my own observations. Look, what stage of a market maker model is candle 4? Again, conceptualize what these lower time frame candles look like. Oh. So candle 4 is the what? Silver bullet. Yes. Silver bullet is the lowest lowest liquidity or lowest resistance liquidity run. LRLR condition is existing here, right? It's that last 25% of a swing grade, which you guys have seen me do as well. See how everything I trade comes together? Remember swing grading? How many of you guys have seen my swing grading lecture? Talking about the different quartiles of a market maker model as they pertain to different phases of distribution, right? That is swing grading. And the fourth candle is what? The LRLR silver bullet, right? And then the halfway point forms what? The high probability order block or breakaway gap. Which candle do I trade of this swing grade? Which quartile, guys, am I trading? Put it all together. Put it all together. What quartile am I trading? 0.25. Known as what in swing grading? The SMR or the low risk entry. Right? So now go into my swing grading lecture right here, and you'll see this. Notice how everything I've ever made for you guys is just consistent? It all builds towards this concept or these series of concepts I'm teaching you. Right? That's swing grading right there. I'm putting some pictures in the chat for you. Here's an example. See? You guys see that? This is swing grading right here. This is something that I've learned. Now, I learned this from when ICT talked about it vaguely. No one ever taught me this in terms of a mentor, but I learned this from ICT, right? This is how I use swing grading, and I incorporate it with what? These candle formations. Remember, what is the model called? The Primo model is the creation of swing points. That's the logic. Swing points created in these candles. Smart money reversal down here in candle 2. LRE offered in candle 2. If not, trade candle 3. How do I know candle 2 is going to offer the LRE? The 4 confluences of expansion. Small opposing run, accumulation before, potential double purge, SIST early in the candle. Are you putting it together, guys? Do you see how everything builds on each other? When you get to candle 4, this is known as the next day model. This is known as the creation of a daily swing. This is known as the SMR. See the names? We're creating the daily swing when the third candle forms, right? Because now we have an opposing delivery state candle. We have a local saddle point in the market or a swing point. Creation of the daily swing. Trade what? The next day model. Candle 4 and candle 3 are going to be expanding, but often candle 2 expands. This is the Primo model. This is the T-Trades fractal model. Actually, let me annotate this all for you. This is the Primo model, my model. This is the Fees' model, okay? This is the TTFM. This is next day model. You guys understand how it all builds? All of the ideas we're talking about are consistent. It's just entering during different phases of price distribution, okay? So fees will enter during the smart money reversal. T will enter in the third candle, anticipating the creation of the swing that's confirmed by the change in state of delivery of candle 2. An MXM trader says if the draw is not met, this candle has nowhere else to go but what? Expand, right? This is how you build a swing point narrative, okay? Piece by piece. Very interesting, right? This is a cool one to keep in your notes. So when you see different language and you hear different language, right, about trading, you're like, there's so many models. Are we not all trading something similar? What you need to understand is the logic, okay? It's the logic that will differentiate you and allow you to actually take winning trades. Because if you pattern trade any model, it's going to fail you because you're missing the most important thing on the chart, which is the draw. You're understanding why this swing point should form here, right? And whether you want to trade the reversal candle, right, the FE's Primo model, whether you want to trade the fractal model, or whether you want to be a purist and trade the next day model, it does not matter to me. I'm going to be teaching you the logic for how to view price in these swings, because that's how all price moves in the market are grounded. Done. Okay. All right. Anyone have any questions about that before I move on? I know I get DMs every day saying, what's the difference between you and the third candle or the TTFM? Or why does MXM Trader focus on this candle? Do you see how they're all different parts of a distribution? This in here is the low risk entry area where I like to trade. Here is the high probability order block that's being formed in the higher time frame. And then here is the silver bullet, right? This in here is your silver bullet. This is your and this is your sweet spot LRE SMR. They're all just three sides of the same coin, if that it makes any sense, right? They're all the same logic, just different phases of distribution. What does pattern trading mean? I mean trading this candle here on a sweep of the first candle low like this without any higher time frame key level SMT and reason to go higher. So if there's no draw up here, if the draw doesn't exist up here, like I have right here, if this doesn't exist up here, if it's down here, then this is just going to do this, Paul. And how many times? I mean, look, go into a day like this, and you'll see that if you're trading against the draw, right? If you're trading against the draw, any higher, like say for example, this will only give you a very shallow run, and then you'll go higher. Same with this. You don't want to be trading this move. You'd rather be trading that move. So again, you'll be able to see this when it fails. When it fails, you're trading against the direction of your draw. That's what I'll say to that. And we'll do some examples. Okay, let's do a few examples and then we'll call it. I mean, this has been extremely comprehensive so far, so it will take some studying. And I'll post this after, by the way. I'll post this on the lessons. I'll put a recap, and then I'll also post it on Twitter for those who weren't able to make it today or be in the server. Again, I offered a free trial for the Discord guys, so if you just wanted to come in for the lecture, feel free to leave after. It's all good. Check out some of the lectures in here. Feel free to stay and trade for a week. It's completely up to you. I just wanted a place to host it, right? Okay, let's look at some examples. Let's start with a very high time frame example. Right? This would be how a swing trader would use the Primo model. We're going to call, which is essentially Fee's second candle model. Okay. We're going to start off with the time frame alignments. Monthly key level, daily reversal signature, C2 formation. That's the time frame alignments, okay? Let's do it. I'm going to pull up two charts now so we can see all of our SMTs. I'm going to get rid of everything. So this is, if you want to be a swing trader, you're going to start from now on, this is how you're going to swing trade using my model. Again, my model can be applied to all time frames, which is the best part of my model, is that you can use it as a swing trader, a day trader, or a scalper. It doesn't really matter. Okay, let's do the monthly key level, guys. I'm going to choose this monthly external range low. So this is my key level. It's a swing low. It's not a fair value gap. It's a swing point. Right? Price comes in, creates a high, and then it runs that low. It's actually this low right down here that we form SMT with the YM. So this is a swing point on the monthly chart. I'm going to mark that out on all three indices. Swing point on the monthly, swing point on the monthly. I'm going to need one more chart just to show you the SMT, guys. It was with YM, and I only consider YM for higher time frame divergences. If you know, you know. I don't use YM on the lower time frame, but I will use it on something like a monthly chart. Okay, first step, defining the key level. So, key level, monthly ERL. Key level, and key level. Okay. First things first, guys. Once we have a monthly key level, what time frame do we go down to? Someone tell me in the chat. From a monthly key level. Daily. We're now going to be framing a C2 reversal candle on the daily from the monthly key level. Remember, we start our analysis on the higher time frame, and this is the swing trading alignment. Daily time frame is the lower time frame. I'm going to get rid of YM now, guys. I don't need it. I already have my divergence. So monthly ERL, right? And I'm going to put in my divergence that's formed. SMT with a correlated asset, and SMT with a correlated asset. Okay, cool. It's actually this low all the way down here. Now I want to see a C2 formation. On what time frame do I want to see a C2 formation, guys? Based on this. Is it the monthly or the daily? What am I trading? What am I trading? What chart? Am I trading the daily chart or am I trading the monthly chart? You guys tell me. Monthly, yes. So remember, I am framing a C2. This is the previous month low that we're wicking. That's the previous month low. I'm anticipating this monthly candle to form a C2. So I want to look at my criteria for expansion. What are those criteria? So the first thing I'm going to do on this time frame now is mark out the open of that monthly candle, obviously. This is the monthly open. Remember, we're going to use our criteria, right? So this is the previous month low. I don't need to keep that on my chart, but I can if you want. This is the potential C2 forming, right? You guys can see the logic building now. Logic. The monthly open is right here. That's why you'll often see me use an indicator like this. And the reason I'll use an indicator like this is so I don't have to manually plot the monthly open, but you can see, for now, I'll have it right here, okay? Cool. Here's a monthly open. Did we deviate away from it by what day? So let's do all three criteria, okay? First one, do we have a double purge? No, right? This is the previous month high. Again, this is more complex, guys, because I'm giving you way more than a lot of other educators on just pattern trading this. I'm making you look into candle 2 and think of some things logically, as opposed to just saying key level SMT SIST. You could go. There's lots of really great educators who are going to teach you great models for just that logic. I'm going to teach you to look at candle 2 more. Consider it more than you have before. Okay? So, do we double purge the previous month high? Yes or no? Everyone should be able to see. Do we take out candles 1's high first? No. Okay, no double purge. That's one of my confluences. Someone name another confluence of mine. The deviation from the open, how large is our wick, right? Our wick to the low is 2.5% on NASDAQ, 2.5% on ES. So about 100 points on ES and 600 on NASDAQ. It's a pretty meaningful deviation below the low, but is that outside the realm of possibility for an expansion? Again, use the logic for how much you see daily candles expand or monthly candles expand. Now, Afiz, I want to be more mechanical. I want more data. Well, you could use the average monthly candle distribution. Now you're getting technical and you're using data to support that statement. I'm just telling you to look at it, but here, let's maybe take an expanding month and look at the average, okay? Let's consider this to be an average expansion month in the market. It looks pretty similar to other average expansion months. So let's just use this one. 1,600 points. And on ES, an average expanding month, 300 points. So we have less than a fifth of that as manipulation below the monthly open. Is that considered a small wick? You guys say yes or no in the chat. Small, does this meet the criteria? Let's put up some monthly candles here. This is actually a really good lecture, guys. I'll record this and upload it because I think there's a lot that you can learn. Okay, cool. Let's get rid of these. I just want the candles. Cool. Okay, so do we have a large or small wick here, guys? Relatively. Right? Compared to the average monthly expansion, which we set on NASDAQ was 1,600 points. Remember, look at the average monthly expansion candle. We'll just use one of them. We'll say a candle like this, which looks like an average expansion. Again, you can be more empirical with your data and go in and actually run these numbers, but I'm just going to use this candle. Okay, it's 300 points on ES, and on NASDAQ, that same candle is 1,600 points. Okay, so this manipulation below the daily open is, I'm just going to get rid of this. It's annoying me. This manipulation below the monthly open is 500. So 1,600 is the average, and this is 500, right? So 1,600 divided by 500, or 500 divided by 1,600 is what? It's about 30% of the average, right, expansion of the month. So I think that it can still move higher, right? It's not like it's using all of its coil. Let's say all of its coil is 1,600. Is that a relatively small wick? That's one confluence. It's close enough, right? So trader cost, do you think that there's still room in this candle for expansion? You tell me. Yes or no? Without seeing it, just based on the fact that there's 1,600 points usually in a candle. How many points to the upside could we get then? 500? 500, that's 1,000. So there's maybe 600 more points of expansion, right? So let's say maybe there's 600 points of expansion higher, right? If it uses all of the coil. Again, that you can be more empirical with this, and there is data tools that you can use, like StatMap, right? The StatMap shows you average manipulation levels, for example, but I don't need that for this model because I'm just going to say, what's another confluence? The time at which it takes and if it displaces back above the range. So what can I see? We open the month, we trade higher, taking out some form of buy-side liquidity first, inducing longs, then we trade lower. Now I get my signature forming. So this is where it becomes more signature-based, right? Inversion fair value gap, SMT. Look at this change in the state of delivery right here. ES prints an up-close candle. This is a bullish candle. You have to look really closely to see it. Right? ES prints an up-close candle. NASDAQ has a down-close candle here. That told me a lot about why ES was stronger, because ES shifted delivery state and inversed the fair value gap with more displacement. But that's a conversation for another lecture on relative strength. But if you guys know, you know, because I've been trading ES all month for that reason. Okay, we're in a bullish program now, right? Bullish program. So now we're in a daily buy model. Where would my entry be? Well, SMT, IFVG, change in state of delivery. I market enter on the change in state of delivery. Or, if you guys know my entry model, the IFVG. So that's candle 2 forming its entry. So for me, when we retest the inversion fair value gap, or when we change delivery state, either one, I will enter. So on NASDAQ, if I was daily trading, limit goes with the IFVG, risking the low, targeting 2R. So if NASDAQ hits here, 2R has been delivered. Okay? Now, if you're really smart, what are you going to risk here? You're going to risk this low? Where else could you potentially risk, guys? Where else do you see me risk every day on stream? Anyone who's in my community, where do I put my stop loss usually to get a better R on candle 2? Rejection block. Yep. Rejection block low. There you go. For me, on the higher time frame, if we come in past the halfway point of these wicks even, this rejection block is the lowest down close candle into the key level. If we come past that wick, we're probably going to take the low in my mind. So I have no problem trailing it to either the halfway point of that largest down close candle's wick, or even just this swing low. And now my risk to reward is significantly better, right? Now I get 2R here. So I miss my 2R objective by 2 points, essentially. So essentially, as soon as ES gives it to me, I would take it on NASDAQ. So you've already done and taken a winning swing trade using my model. So using my model this month, you're plus 1.9R. Fantastic. You're very happy with that 1.9R. And why would you take it at 1.9R? Because look what happens at the highs. ES hits that 2R objective and forms SMT. So the minute ES takes out that high on this day, you're closing. Does that everyone understand why? You would be closing on NASDAQ when you hit the external range high. All my students understand that, right? We TP at SMTs. Because SMTs get us into the market, SMTs take us out of the market, obviously, right? You see me do that every day on stream, so that should be clear to you. So for you, you take a winning trade on NASDAQ there. On ES, which is stronger, you'd be entering on what? For me, in candle 2, I'm entering on the change in state of delivery because it might not retest it. Remember, candle 3 doesn't open till here. That's candle 3. So we're currently still in this candle. Can you guys in your head almost visualize these candles now after this lecture? The biggest accomplishment for me is if you can visualize these higher time frame candles in your own head now. Because that was the changing point for me in my trading, was being able to see these candles on the higher time frame in my head based on what I'm showing you on the lower time frame, right? So we're in this candle too. So I'm entering as soon as I see that change in state. I'm risking again here. I'm targeting the external highs, right? Or 2R. Now here you can see my risk is much higher with this entry, but the market's also more bullish on ES in candle 2. So again, I have to define my risk. What do you guys think this is going to be? Do you think that once price trades above this candle here, again, use logic, not patterns, trades above that, in versus this fair value gap here, do you think that price should come back into this fair value gap down here? Yes or no? Absolutely not, because if it did, the market would not be doing what in candle 2? Think about the higher time frame candle in your head. Think about the higher time frame candle. What would it not be doing then if it came all the way back down to that low? It wouldn't be expanding. It would be doing what? What's the word that it would be doing? It wouldn't be expanding. It would be consolidating. Reversing is a lower, in this case, it's going to be lower time frame up and down. So that's consolidation, right? Right, Dom? Think about it. It's going to go up and then down. So then it's not an expansion C2. So if price came back to that level, I don't want to be in the trade anyways. Okay, that's how you define your risk to reward, make it better. So when I enter here, that's a breakaway gap. So for me, that low needs to be covered, but realistically, the minute we trade and create, so this would be 2R now, it's that high. The minute we create an opposing candle, there you go. That truly should be your stop loss, which is why I'm not saying this, guys. Go look at my charts. From my now, I'm not. This is not hindsight. Look at my market analysis channel when I called the breakaway gap forming. Where's my daily analysis? You guys will have to look at my market analysis channel. I called it the daily breakaway gap like a month ago, or at the beginning when that first move happened. We said this should stay a breakaway gap the minute we formed that opposing down close candle on the 16th. Because once we close above it, then we're not coming into there. That's how you dynamically change your risk to reward inside this candle, because you do not need to say that's your low. Do you guys, if it came all the way back down, guys, you don't want this trade. Trust me, you don't want it in here anymore, right? If it came all the way down to here, you just say, I just don't trust this candle to not just do this on the higher time frame and look like this. Because if it came back there, the candle closes like this. Remember, visualize the higher time frame candle. Is that a C2 expansion or a C2 consolidation? It's a C2 consolidation candle. So you don't want to be in that trade anyways. You'd rather wait for what? The next candle to open, right? Cool stuff, right? Okay, so that's your example on the daily chart. So simple, right? You can see the model prints on all time frames. Now let's take it this and say, okay, if he's like, I'm not a swing trader, I'm not going to be using a monthly level. Okay, fair game. Let's use this same example on a different time frame. We're going to go through all the time frames. It's going to be cool. So you're going to see how it works. So let's use a weekly key level. Again, we had this weekly swing point in here. That was our SMT. Remember, IRL is a key level. So now what's the lower time frame? Someone tell me. 4 hour. Well done. On this 4 hour chart, we're going to look for the same exact signature of price. I have my daily dividers here, but we can hide those for now. We don't need it for this analysis. I just like to have that every day when I'm day trading, obviously. Cool. Again, let's use the weekly open for this week. Notice why these levels like weekly and monthly opens are important. Now, I usually don't like swing trade, so I don't have the monthly open. But for this month, it's actually important. I do usually have my weekly and daily opens. So on here, I'll have weekly and daily opens. You guys will see this on my day trading charts because I'm using the same logic, guys. I just don't go over it every day on my stream with you, right? So now look, let's rewind. Yeah, let's look at the weekly reversal candle because there's been multiple weeks. So then look, what candle are we framing in here? What type of C2 is this? Again, just say it to reinforce it in your mind. What type of candle are you framing on C2 here? Reversal expansion, right? Perfect. So you're going down to the 4 hour and you're looking for the signs of a reversal expansion. Again, manipulation away from the weekly open. You guys said, well, what about weekly profiling? What day? Again, remember this. Okay, we're bringing it all together. Time, right, in the candle is just as important as price. Time in the candle of manipulation and SysD is just as important as price. What is weekly profiling telling you here? When do we form the low? Monday, 2 a.m. Then we get a change in state of delivery, which is a closure above the consecutive series of opposing candles into the key level on Wednesday. And you're like, okay, so Monday made the low, right? Here. Wednesday expanded through, and the rest of the week just chopped. However, you can see that before the change in state of delivery forms on Wednesday, we get an early indication of change day delivery, inversion fair value gap, not one, but two. Look at price holding these levels, right? Look at the sensitivity. This is giving you an early indication that the market is primed to expand because Monday made the low of the week, and then we expand off of that weekly candle's low placed on Monday. We get a change in state of delivery and two inversion fair value gaps. Why do you think I longed CPI, guys? Remember last week I longed CPI before CPI? Because I saw the way we were reacting to this 4-hour key level. That was my analysis, right? So here we go. Now we have the inversion fair value gap. You have the confirmed change in state of delivery right here. But of course, for me, right, the inversions were really what gave it away for me, specifically how price respected these. In addition to what? What do you guys see in this leg here? Everyone should be able to see it. What is in this leg? Multiple of them. Displacement, fair value gaps. The market is displacing back above the weekly open. So the weekly candles opened low, formed the low of the week, and is now displacing higher. These inefficiencies before the change in state of delivery clue you in to what type of candle do you think you might get? A reversal expansion candle, because we're displacing with lots of time left in the candle higher. Okay? And price made its low early in the candle as well. Again, two core confluences we're using together, right? So your entry would be in this inversion fair value gap, or you could even use the fair value gap if you're just trading the weekly 4-hour. This is known as the weekly range traders. This is a weekly range trader time frame alignment. So you're trading that 4-hour fair value gap or inversion fair value gap, this H4 BISI or this H4I FEG. Notice how they're stacked. What's that called? Fair value gap, inverse fair value gap? What do you guys call that? A balanced price range. Yep, you take that BPR, you long the open, because you don't know how low these wicks will go. What is the protected stop loss? Remember what I said, right? We're going to be using either the wick low, or you can use below the 50% of this rejection block would be a good stop. So I use the swing point below it, and I target 2R. Done. So the model gave you a 2R trade, and on the ES, it looks like this, right? Long either the first fair value gap or the inversion, depending on your risk to reward. Some people will demand a price trade into that inversion. I won't, right? If it's sysd here, I probably, honestly, if it's sysd here, guys, would have market longed that, risked this, and still targeted the other side of the range. I'd still be in this trade, right? Until we formed this manipulation, then I'd move my stop up to there, and then I'd take my 2R earlier as well, right? So I would use a dynamic stop, but the proper entry would be maybe this 4-hour fair value gap, risk that low, target 2R. There you go. So ES and NASDAQ both give you a 2R trade. That's the weekly 4-hour. You're also going to notice what forms in here for the lower time frame. You guys are already seeing it, eh? I mean, we're going to do it as an example, but do you already see what's happening in here? What do you think this key level is forming? For what time frame alignment? So you guys see it in there, right? 4-hour. What do you think I'm going to look for in lower time frame? 15-minute, right? Yeah, you guys see this week provided you examples on every single time frame, which is why I chose to do the lesson this week, because I'm seeing all of the clear examples. Yeah, if you guys are looking for C3, so again, let's mark out C3 open. Yeah, there you go. Friday. So let's mark out the next week. You can see candle 3 actually reached the draw, right? It actually reached much higher than the draw. But this is candle 2. Now look at candle 3's open. So say you miss it. How do you think I had a bias for this week? I'm doing exactly what I did here, okay? Okay, there is our weekly open. I have it marked out, right? I use this line, but you can also see we have the weekly open. Look, small deviation below the open, right? What's the higher time frame array? Do we need a higher time frame array for this continuation? Yes or no? Do I need to have a weekly key level for that continuation, guys? No, right? No, you don't. You need a SMT SysD. Right? Oh, there you go. Candle 3 does not require. Let's pull this to the actual weekly open. We don't require a higher time frame key level. The nice thing is we have one anyways. Look, where is it? Monday. We have this opposing candle here that price trades into the wick of. But you notice there's no daily key level. So if you're waiting for a daily key level, you're like, ah, shit, right? I wanted price to come back below this low and form SMT. It's not going to, is it? Because you're in that weekly continuation. So you have to recognize that. Here is that key level on the 4 hour. Again, just trading the 4 hour chart, guys. We're not looking at the lower time frame alignment yet. Candle 3. Right? Comes in, forms an opposing run. We have to wait for the SMT. No SMT forms in here. So that's not the opposing run. You know what, guys? Don't even look at the fair value gap. Because what did I say for candle 3? We just need to see an opposing run with SMT. It comes into the same time frame inefficiency, but you can see there's no. Is there any SMT here on the 4 hour chart? Yes or no? Is that an SMT or not? No. Do you notice there doesn't need to be on that time frame, right? For this model, what you need to see is a continuation, which is going to be on the lower time frame, so you wouldn't be trading it. So for here on the 4 hour, what you would wait for is a 4 hour SMT to form because you're not going to be considering the lower time frame. So what I would wait for is a 4 hour SMT to form, which is not going to be until here. Notice this SMT that forms. Now I can trade it. So in this move, I'm not trading this lower time frame model. If I'm just trading the 4 hour chart, am I? I'm waiting for candle 3 to open. SMT, SysD. Here is my SMT. You guys see that SMT in here? Everyone can see that? We can all clearly see that SMT. If I'm just trading the 4 hour chart, remember, we're not going down and looking at whatever happens in here. Don't look at this because that's the next example of the lower time frame. Just looking at the 4 hour, waiting for the SMT to form, waiting for the change of state delivery. The consecutive series of opposing candles is going to be this, right, into that key level. You could even use this one, but I would use these. As soon as price closes up through there, market, stop loss for me. Again, I'm not going to use this low all the way down here. I'm going to use the halfway point of the lowest candle. So in this case, something like the rejection block low, target 2R. Boom, right? NASDAQ doesn't give it to you, but ES does. Right in here, SMT, take it. Where's the SMT low? There you go. Okay. So you can either use the SMT low as your stop loss or the rejection block. For me, I use dynamic risk. So as this candle forms a down close candle, we close above it. Now I can just risk the low of that down close candle. I don't want to see that get taken. You see how the risk to reward drastically improves, right? So that would be your next day, the third candle continuation, okay, of the 4 hour market maker buy model. Any questions about that? Pretty clear. Let's do another example. Now that we're on this chart anyways, and we all looked at it, let's do a 4 hour, 15-minute alignment. We're going to do every single time frame alignment, and we're going to go down just so you can see how clear it is. 4 hour, 4 hour. Right. There you go. What time frame? 15 minutes. Again, here's where we go into our sessions. Now we're really just day trading, aren't we? This is like true day trading. We have this 4 hour PD array. We need to see SMT inside of here. We look in the 15-minute chart for SMT. Beautiful. Devil's Mark liquidated. There is my stop hunt. I noticed that ES forms the SMT there. Fantastic. Okay, what do I wait for? Changes to delivery. Change this to delivery right here. Right. Now notice, what candle does that change this to delivery form on, guys? Is this a candle 2 reversal expansion or just a candle 2 reversal? All of these candles don't reverse. So we're actually waiting, right? In here, by the time we get that change day delivery, what are you going to notice about the 4-hour chart? We have a brand new model forming on the 4-hour. Do you see that? Look, by the time you get that 15-minute, sure, you can utilize this, but it's really 1, 2, 3 4-hour candles have passed, and we've actually printed a new 4-hour model that's way more relevant, right? So then you go back to your 4-hour charts, and you're like, okay, so clearly the next candle did not expand, right? Nor did the next 3 candles, really. They just confirmed the bullish order flow eventually. Look at this. Beautiful SMT, right? Key level was already established. Now we have a stop hunt below these lows. So our key level is this external range low, right? In here, these lows down, right? Okay, now we have a new 15-minute model forming. Also, for the purists, I mean, look at the halfway point of the wick, just because, you know, there's just general ICT concepts in here, right? The halfway point of the wick is going to be a part that you want to hold. Look how ES is way stronger. It doesn't even come into the wick, and NASDAQ comes into the wick. That's how you know ES is going to be stronger on the move up, but that's irrelevant. We have a new SMT that forms at a key point of interest inside that wick. Now we have a new 15-minute model that's forming. Chain to stay delivery. Chain to stay delivery. Okay, you're in candle 2, right? This is look at the 4-hour chart. Candle 1. Here, the sweep and expand. The sweep and expand. So you want to get involved in candle 2 if you see the signature, right? So let's look at candle 2 where it opens on the 4-hour chart. Again, we're doing an example for every single time frame. So for no matter what time frame you trade, guys, you're going to be able to see an example here. Let's mark out the 4-hour open together. 4-hour open is right at 6 a.m. Mark that out on here as well. Cool, let's get rid of this 15-minute SSD. Okay, this is our SSD. Change in the state. Cool. All right, model forms, right? Manipulation below the open. How much time is left in this 4-hour candle? Well, look. When we get the SSD, we have a new 4-hour candle actually opens right in here at 10 a.m. Perfect. So you're actually trading. There's a 4-hour candle open, sorry. It's right there. Look how beautiful that is actually for an expansion. So do you notice the low was created with how much time left in the 4-hour candle? All of the time left in the 4-hour candle, right? The low was created at 10 a.m. Okay, perfect. Prime for an expansion, right? Okay. Train to stay delivery, lots of time left. Look how much we have, so much time left in this 4-hour candle, right? Lots of time for it to expand. Very, very small manipulation or deviation below the open. Very small. SMT right at 10 a.m., right? Perfect. You get that change in state right in here. Long it. Range high is your objective. I'll use that rejection block low and just target 2R if I'm trading that 4-hour candle. There you go. Another 2R trade is taken. Perfect. Both indices give it very, very nicely. Pretty nice stuff here you're actually seeing. Okay, let's do one more example and then we'll call it. So that's the 4-hour model. Now let's look at this day and do the 1-hour model as well, okay? So again, the 1-hour model is going to require us to know that we're bullish on the day. Like I said, the biggest part of this model, if we know all this, why do we still take stop loss? Well, because trading involves risk and we still take losses. Like our model's still going to print losses. But when we're seeing this now, right? We're looking at examples that win. There's also lots of examples that lose. Like for example, I can show you a losing trade I took last week. where I went long, it just stopped me out first. Like it chopped me out. Like I did an hourly M5 alignment. Let's look at it. No model is ever 100%. You're going to take lots of losses. Don't worry. I'm just showing you some examples here of models that printed wins. Okay, let's look at this day. Which day was that? Tuesday? Let's do an hourly M5 and then we'll call it. Let's do yeah, let's do this day. Let's turn our daily indicators on so we can see everything. Again, this is the lowest time frame that I would trade, and this is the time frame that I personally trade because I like the hourly chart the most. So let's do Tuesday. Perfect. Someone's screaming outside. I don't know if you guys can hear that. Yeah. So we wait for the daily candle to open, right? Again, let's mark out our daily candle as well. Oh my God. Do you guys hear that outside? Someone is actually just screaming. I don't know what is going on. Sounds crazy. Okay, so this day opens up. Oh, this is our short day. Sorry, let's not do this day. My bad, guys. Let's do Wednesday. Here we go. Or let's do this Tuesday. Because we have a short day on Monday here. I remember that. Okay, let's do this day right here. So we're in the New York kill zone. That's when I would take trades. And we're looking for an expansion higher. Again, I'm going to zoom out and show you my daily draw on liquidity. So on this day right here, I'm looking for this daily high, and I'm looking for this daily high, right? Because the end goal, like we talked about from our higher time frame analysis, is going to be this high. So again, we're always trading in that direction. Now I go down to the hourly chart inside the session, which I trade, which is going to be the New York AM session, right? And I'm waiting for the kill zone. So where's my sessions? Let's turn on the hours. Perfect. I have so many indicators I just don't have on even. Okay, we're gonna wait for the New York session. That's session I trade, and we're gonna wait for an hourly key level with SMT. Do I have one? Inside the New York kill zone, right in here. So coming into 5 a.m., I see I have this fair value gap created on the hourly. This is a candle 3 model. Okay, fair value gap. In here, before the kill zone, what kind of candle do I get in here, guys? It's a reversal candle. I wouldn't call it an expansion candle, but would you guys call that a reversal candle? Yeah. Well, look, we'll qualify that as a reversal candle because we're actually going to be trading the next candles. We're trading these next candles. In fact, you can see the reversal is confirmed in here on the 5-minute chart. So let's go here. Let's find that 5-minute model that forms. Mark out. Is there SMT in here? It's the question I have. I actually don't see SMT in here. I wouldn't call this the reversal actually, because I don't see SMT on the 5-minute chart there. So what I would do is I'd wait for a new hourly PD range. There's actually one that I missed. I can see it right here on the lower time frame. This is the one I missed on Tuesday, which is why I took a loss, guys. But it's this small volume imbalance on ES on the hourly. Because I don't use opposing candles here, but I could use that order block, but there's a small volume imbalance there. Okay, so do you guys see that volume imbalance? Now we're going to the 5-minute, and we're trying to confirm this as a reversal expansion candle. That was the one I missed. Paul, this is a losing trade I took because I didn't see the volume imbalance. So I actually took a long earlier, expecting a continuation. And I didn't see that key level. I missed it. And here is where I get my reversal signature. So we have these lows, which ES makes higher highs to higher lows to, and we have a series of lower lows in here. There's our SMT. Our chain to stay delivery is going to be defined with this single candle closure here, because this is the consecutive candle into the key level. So on the NASDAQ, it's going to be that same candle. here. And this was the long I took as a loss, Paul. So we had this SMT form before. If you guys can see, right in here, below these lows. I used this low right here, Paul. It's actually a really good example. Where is it? Where's the first time we came into it? Yeah, NASDAQ came into that low here. Yep. Okay, so we formed the SMT right there with this candle. There we go. Okay, so that was the SMT I took. I'm going to show you a losing trade. It formed another high resistance liquidity run. It formed that SMT, that change of state delivery. I went long at this candle closure through it, put my stop loss below. I think I put it like here, and then I got stopped out, right? I think I did it on the ES as well. Then we had NASDAQ come in and make we had another high resistance liquidity run where we made a lower SMT and the model printed again, and this would have been the winner. So you can see sometimes there's multiple stop hunts, and especially when you go in lower time frames, it gets a little bit messy because you have multiple stop hunts. But then that's the winning trade that prints. So there you go. There's an example of a winning and a losing trade. So the SMT occurred once. I took this SSD, and then I got stopped out. And then the SMT occurred again, another SSD, and then it gave the expansion. Okay, so that's 3 different examples. Let's do one more on the hourly because that's the time frame I trade the most, and then we're done. Let's just choose a day, guys. This has been jam-packed, so go watch it again after. Okay, I'm going to choose another key level from maybe last week. Just do something that's recent enough that we remember it. Okay, cool. I have this hourly imbalance. Actually, I'll do New York session because I know we all trade New York session for the most part. We have these swing lows right here. I'm just going to label that as a stop hunt in a big bold letter so you can see the SMT that forms below that level. So now we're looking to trade this candle, right? That comes in, forms the low with SMT. And is this what kind of candle is this, guys? This candle too, right in here. Reversal or reversal expansion? Yeah, it's just a reversal. It's just a reversal. And what's the biggest indication of it just being a reversal? How far does it deviate from the open? It deviates the entire large distance away from the open, right? And then let's look when it SSDs. That's how we'll be able to qualify even better. Okay. So the chain of state delivery is going to be defined in here. So it SysDs at 1030, which is within the first half, but it doesn't expand. So it just starts to consolidate. So the entry in candle 2 is going to be, again, what else do you not notice in this leg, guys? What's not in this leg? So we're looking for ideas to support a reversal, right? What's not in that leg? IFEG? Yeah. There's also no what? What do you not see higher? What do you not see higher? What are we not creating? Displacement, yeah. No fair value gaps, right? So is the market in a hurry to, again, remember the string analogy, are we rapidly like pulling that string higher? No, right? The market is not expanding, so it might consolidate. So if you want to enter in candle 2, here's your entry, right? And you can either enter on the chain of state delivery or retest, completely up to you. Let's say you use my entry, you just enter on that SSD. Again, you're going to be risking 100 points, which is a really big stop loss, which is why I wouldn't love this entry, because my 2R would be all the way up here, right? And it's about 1R to the New York high, so this is the draw on liquidity. So fine, it's a decent trade, especially if you're only targeting 1R. But what I don't like about this is what? What do I obviously dislike about this entry, guys? What do you think I just would kind of deter me from trading this entry and not the next candle? Huge stop loss. Yeah, yeah, you nailed it, right? Like I don't want to have to cover it. So say I enter here, even then I'm risking conservatively 80 points, and I have to risk that I want to stay on my 5-minute chart, but even if I go down, I'm going to see that realistically, even if I go to a 3-minute chart and I frame this as like a breakaway gap, I'm not comfortable framing that as a breakaway gap personally. So I would still want to risk that low, which is 70 points. So, and you can see it almost comes into that quote unquote breakaway gap area. So you would need to risk essentially all of that low. I would much rather wait for the next candle to open, right? So then let's look at the next candle's open. So this is 10. Wait for 11 to open. Now we're talking, right? Look at 11. Okay, 11 opens. We need to see what? What are the criteria for a candle 3 continuation? Put it in the chat. Not just my students. Someone who's new here, put it in the chat. Just SMT SysD. Nice. That's forming. Remember, what your job is to visualize the higher time frame candle that's forming. The higher time frame candle is forming its wick. Visualize that wick being formed on the hourly charts. Wait for the opposing run. So we open, we immediately trade lower. I'm asking myself, is there SMT when we trade lower here? Yep, I see it. Where's the SMT? Do you see how we put in equal lows? And we take this candle's low? That's good SMT for me. You can also wait for a swing point divergence, right? Like you have to see an actual swing low diverged at. For me, I know this is a lower time frame swing point. So I'm comfortable using those equal lows. However, if you want to wait for a true swing point divergence, you're probably not going to get entry in this candle, right? Because that doesn't actually ever happen. We never come back below, right, this swing point. So for me, I'm going to use this as the opposing run, and I'm going to use just that candlestick SMT as my as my entry technique, right? Once we close above it. Now, here's a question. Why am I changing my definition of SMT from the swing point to just these equal lows that we created? What about this seeing these equal lows versus this sweep gives me confidence? We're already in candle 3, right? Where is my draw? Exactly, Alpha. Yes, my draw is already higher. So here I'm just seeing that, and I'm like, okay. So as long as price can really hold above this, like you can see again, we form another kind of candlestick divergence right here, right below this point. Once I'm seeing these things confirmed, especially because we're holding the halfway point when we come back in. Look at how not random that is, right? The halfway point of this wick. I know that's an institutional level, so you can even enter when it comes back above or enter on this SysD. But for me, I'm just comfortable. I want to get involved anyway. So if I'm entering candle 3, I'm entering probably once we close here. I'm risking just that low, and now I have a way better risk to reward. Notice how I can actually get my 2R. There you go. So that's the power of a candle 3 entry, isn't it? Right? Because in candle 3, I already know the order flow is confirmed. What am I waiting for? An opposing run, an SMT, and then good to go, right? Gonna slam it. Okay, guys. So this is how I trade. This is a very comprehensive model. This is a very comprehensive lecture. For all the new people here, feel free to stick around, look at all the lectures, and for anyone who's old or anyone who's just going to stay around, this is how we trade every day, right? So this is what we're looking for every day, and now we've kind of put it all into words. Yeah, I'll post a lecture as soon as it's done. Let me know if you have any questions about anything, and enjoy your weekends, guys. Take some time to study, take some time to recharge and relax, and I'll see you guys all on Monday. Okay? Take it easy. Peace. Oh yeah, one last question. What's up, Tyler? My pleasure, guys. My pleasure. We'll answer Tyler's question and then we'll hop off. And again, if you have any questions, guys, put them in here, okay? So from the video, if you have any questions, just put them here. What time frame you trade like session from 9 a.m.? So I trade from 8 a.m. onwards. So I'm looking to either frame the reversal at the 8 a.m., 9 a.m., or 10 a.m. hourly candles. Yep. I trade the hourly M5 alignment, but I use all the time frames to build my bias, right? So I'm going to build my bias like I do from the weekly, monthly, and daily charts. Yeah, so 8 a.m. to around 11. I probably won't trade PM session. No, this model applies to absolutely everything. Futures, Forex, crypto, commodities. Yep. Yeah, I'll upload this. I'll upload this as soon as it's done. So one of the individuals in my Discord named Baymax, she uploads everything for us. So I'll upload it into the recordings. Awesome. Okay, guys. See you guys on Monday. Take it easy. Peace.